Hello everyone, this is Jeevakan. In today's video, we'll look at what is a mutual fund and what are the different aspects to look into if you're trying to invest in mutual fund if you're a beginner. So let's get right into the video. So what is a mutual fund? Mutual fund is nothing but an AMC asset management company which will collect money from pool of investors and it will be investing in different asset classes. So that's what we call a mutual fund. When you are introduced into mutual funds, there are two plans available. One is direct and another one is regular. So what is direct mutual fund plan? So direct mutual fund plan is nothing but an investor invests directly into the AMC. Whereas when it comes to regular mutual fund plan, there is a middleman in between. What do I call by the term middleman? So there will be an advisor who will be helping us to build a portfolio and he'll be making some tweaks or making some adjustments to a portfolio and he'll be helping us to build a better portfolio in the longer term. So in my perspective, I would say that direct plan is the best plan available than the regular plan, because in regular plan you will be giving away more commissions because of the middleman involved. We will be saving a lot of money if you are going for direct plan rather than regular plan. Next thing is, what are the different types of mutual funds available? The first type of mutual fund is equity fund. So this is where we invest our money in stocks like different companies like large cap, mid cap, small cap, and the risk could be diversified based on the type of stocks which you are investing in. And the next type of mutual fund is debt mutual fund, where we invest in government bonds and corporate bonds, where there will be less returns, the risk will be really less, and it is a safest form of investment. The only problem is the returns would be really less when compared with the equity mutual fund. And the third form of mutual fund is hybrid mutual fund. Hybrid mutual fund is nothing but where we invest our money in equity as well as debt mutual fund. So we diversify our money into equity as well as debt mutual fund. In this picture, you can see that there is something called equity oriented mutual fund and debt oriented mutual fund. Equity oriented mutual fund is nothing but the majority of the fund will be invested in equity fund and the minority of the fund will be invested in debt funds. Whereas when it comes to debt oriented mutual funds, the majority of the fund will be invested in debt funds and the minority of the funds will be invested in equity funds. So this is what we call a hybrid fund, and the commissions are really high for this hybrid funds. And the last one is the index funds. So index funds are nothing but the mirror of our index, which is Nifty. So whatever stocks which Nifty is invested in with the equal weightage will be invested in this index funds, and whatever returns Nifty gives will be mirrored here as well. So it is the same replica of Nifty. The commissions for index funds is really less. So finally, coming to the crux of the video, which is how can you pick a proper mutual fund based on considering various factors. So there are many factors to consider. The first factor is expense ratio. So what is expense ratio? Expense ratio is nothing but the commission charged by the AMCs. So the expense ratio should be ranging from 0.5 to 0.75. If it is more than 0.75, it is obviously pretty expensive. In conclusion, lower the expense ratio, better would be the returns we will be generating. And the second one is the risk diversification. So when you are investing in a mutual fund, we should know where our money is getting invested in, whether it is invested in large cap, mid cap or small cap. Small cap companies are considered to be highly risky investment opportunities. So we should know where our money is getting diversified into when we are investing in a mutual fund. So we should do proper research on where our money is getting invested in. So if you are pretty confused on where your money should be invested in or how much weightage should be invested in equity or in debt fund, so there is this concept of 100 minus age rule, which we've explained in our previous videos, which is nothing but you should subtract your age with 100. If your age is 25, you should subtract with 100, which is 100 minus 25, which is 75. So 75% of your holdings should be in stocks and 25% should be in debt instruments. So this is how you diversify your risk. And the third factor which we need to look at is AMC track record. So what is AMC track record? So whatever mutual fund which you are investing in, we should look at its past performance. So how much returns it has given in the last year or in the previous year or in the last 5 years. So we should evaluate based on its past performance in order to get a better understanding of how much it will give in the near future. And the next factor is time period. So we should be sure of how long we should be investing in mutual fund, because if you are trying to invest for 1 or 2 months, obviously the markets are quite volatile and in the short term our investments will not be profitable. But obviously if you are trying to stay invested for 3 or 5 years, obviously our investments will grow and it will give us handsome returns. And obviously the time involved is much more important when it comes to tax benefits as well, because if you are holding your investment for more than 1 year, obviously you will be eligible for long-term capital gain tax, which is just 10%. But if you are holding an investment for less than 12 months, it is somewhere around 15% for short-term capital gain tax. So longer the period you are holding some investments, it will be better for you to save some taxes. And the last one is outperformance of index funds. So what do I mean by the term outperformance of index funds? So whatever mutual fund we're investing in, we should check whether that mutual fund is outperforming the index fund, because index fund is the cheapest form of investment. The expense ratio of index funds is really less, somewhere around 0.2 or 0.3, which is really less. So whatever mutual fund we are investing in, for the expense ratio we are paying, the return should be higher than the index funds. So that's when it is really worth it to invest in such high expense ratio mutual funds. So now that we looked at various factors, I'll show you where we can check these data and track the performance of the mutual fund which you're looking to invest in. So let me just share my screen and show you where we can find the data. So I personally use ET Money to track any mutual fund performance. So we are on ET Money website right now. So let's search for any mutual fund and track its past performance. So let's search for Tata India Tax Savings Fund. Tata India Tax Savings Fund Direct Growth. So in this fund, so the overall details about this fund will be present here. So the details which we'll be checking is the expense ratio, right? The first thing. So the expense ratio is present towards the right, which is somewhere around 0.76%, which is pretty decent. And the second thing is the risk diversification, which we'll be checking. So the top stock holdings for this fund is ICICI Bank, Reliance Industries, Infosys and HDFC Bank. And the allocation based on market cap is large cap is 67 and mid cap is 22 and small cap is 7.22. And 97% of its fund is present in equity. So when it comes to its past performance, this fund has given negative returns in the past 1 or 2 months, even 6 months. But when you consider it in the longer term for 1 year or 3 years or 5 years, it has given positive returns. It has given an average of somewhere around 12 to 12.5% for the 5 years. And in the short term, it has given 6% loss. So this is why you should consider investing for long term when it comes to mutual funds rather than investing for short term. Last thing we'll check for an index fund, which is UTI Nifty Index Fund Direct Growth. So this fund has given, or see, if we can check the expense ratio, it is just 0.18% because there is no management required for this fund, because it is the mirror of Nifty as we discussed earlier. The risk diversification is mostly into large cap, 100% is large cap as we discussed. So whatever Nifty is, whatever Nifty weightage is, it is the same here. Reliance Industries 12.86, HDFC Bank 8.1, Infosys 7.67. So it is the mirror image or the replica of Nifty. And this is the returns it has given in the last 5 years. If we can see it, the last 5 years it is given 12.5%, and in the short term it has given 5% loss. So that is why we discussed that in the short term equity fund will be quite volatile, but in the long term it will be profitable. So that is why it is better to hold your mutual fund investments or any investment for more than 1 or 2 years in order to get better returns. So whatever mutual fund you are investing in, it should outperform the Nifty index fund. It is a mirror image of Nifty and is giving somewhere around 12% return for an expense ratio of just 0.18. So whatever mutual fund which you are investing in, it should outperform the index funds in order to give better returns. So this is how you track the data for the mutual fund which you are trying to invest in. And as I said earlier, I'll show you why the direct plans are much more better than the regular plan by showing a clear example. Let me just share my screen again. This tabular column will tell us the difference between why direct plan is better than the regular plan. So consider in this tabular column here, we are SIPing an amount of 25,000 for a tenure of 30 years. Consider we are investing 25,000 monthly for periodically for 30 years, and the annualized return is somewhere around 12%. And for regular plan, the expense ratio will be 2% or more because of the middleman involved, because of the advisor involved. So that's why it is 2% here, and 1% for direct plan because there is no middleman involved. We'll be directly investing in mutual funds. So that is why 1% is present here for direct plan. And in this example, you can see that in the final corpus, the amount which will be getting in regular plan is 5.17 crore, whereas the amount we will be getting in direct plan at the end of 30 years is 6.46 crores.
So in overall, we can say that the outperformance by direct plan is 1.29 crore, which is around 20% more than the regular plan. So that is why the commissions in your mutual fund plan should be as low as possible in order to get better returns. If you consider in the shorter term, it will not look as much big as possible. But if you consider for the long term, it makes a huge difference of almost 20%. That is almost 1/5 of your overall profits, as you can see in the image here. So if you are considering staying invested for a longer period of time, it is better to go with direct plan with less commission, with expense ratio of less than 1% or 0.75% in order to get better returns at the end of your tenure of 5 years or 10 years or even 15 years.
So by looking at this example, we can clearly say that the expense ratio plays a major role for the type of plans which you are trying to invest in, whether it's direct or regular. And we can clearly say that the direct plan is much more better than the regular plan. So that's it. This is how you track a mutual fund which you're trying to invest. And we can track the data and we can come to a conclusion on whether we need to invest in based on the various factors which I told you right now. So thank you so much for watching the video. Hope you'll find it useful. Signing off until next time. Cheers.